Hi, I'm Keith McCullough. Welcome back to our Seeking Alpha partnership, where today it's going to be a fun one where we can talk to the winners of the Harvard Financial Analysts Club stock picking contest, or more of a pitch. So again, we're going to go through this with Kevin Lee and David Redding, who are the winners from Harvard. So the Harvard Club hosted it against other colleges, and it just turns out that Harvard ended up winning the competition. So welcome, guys. Thanks for making the time to come to Stanford.
Thanks for having us.
Thanks for having us.
Yeah, it's this competition, you know. Not surprisingly, Harvard wins the competition. Can you kind of explain it, just in terms of how it was laid out and what the format was?
Sure, yeah. So there's a club at Harvard called the Harvard Financial Analysts Club. We provide education for kids on campus and do a little bit of investing on our own. And we reached out to Seeking Alpha to create a partnership, or start a partnership, and then we started this competition. We hosted about 18 schools. 54 applied, and there was a vetting process at the beginning, and then 18 came at the end. Broken up into about 4 groups. We each did our pitch in the first round, and then the best pitchers, best 3, were taken to the final round, and they pitched again in front of another set of judges, and we ended up winning.
Nice. So was it judges, or was it like Shark Tank? What was it?
It was. There were 3 judges on the final panel, and one was like a guy from Fidelity, a guy from a hedge fund in Boston area, I believe.
Nice.
So investment professionals who they would listen to the pitch, and then they would. There was some Q&A at the end, and there were some pretty sharp questions. So definitely no room for error there.
But you got to play in front of the home crowd. You got your Boston base, you got the Fidelity guy, you got the Boston hedge fund guy. That's good. And I heard you beat these Canadians in the final too.
Yep, University of Western Ontario. We beat them. Yeah.
That's great. Well, congratulations.
Thank you.
So what is the pitch, Kevin? What is the pitch?
So Consolidated-Tomoka, the ticker CTO, it's basically a real estate owner-operator based in Florida. And they have 2 big assets. So the one is they have a little bit more than 10,000 acres of land near Daytona Beach, which is along the coast. And then they have about 1 million square feet of high-quality income-producing property. So that's buildings leased out to people like Walgreens and CVS. Mm-hmm. And the management team is in this process of basically converting the land where they're selling it off and then using the proceeds to reinvest in the income-producing properties across the country.
So they've had this land forever.
Absolutely. Yeah. So it's very cheap on the books. And so in the process of selling it off, they can reinvest. And the catch is they can reinvest tax-free because they can defer these tax liabilities using a loophole in the tax code called Section 1031, where basically all properties are considered like-kind to each other.
Which is great.
Yeah.
And they're a C Corp or a REIT?
They are a C corporation, but there has been discussion of converting to a REIT, which would be even better for the tax effects. So overall, basically, at the current market valuation, we can basically, the company's basically trading at the value of its land and loan portfolio minus all debt, which means that as an investor, you're basically getting all of the income-producing property for free, which is 1 million square feet.
Wow.
And I think what really makes this exciting is, David and I, as well as our colleagues Carlos, Xu, and Elaine Dai, who weren't able to make it today, we did some primary research on our own, just digging into kind of, management's background, and then also going through Daytona Beach property records to get some insight on, how these land sales will play out. And I think that gives us a little bit of an edge on the market in terms of understanding.
I mean, this is what I love about your idea. You picked a stock that nobody covers.
Right.
You did all your own work. And here you are with this, these nuggets that you're really finding on your own, and you're saying, "Wow, I think I found something that nobody's thinking of." So evidently, that's partly why you won. If you look at these land holdings, David, how do you value them? I guess this is one of the fulcrum points of the idea.
Yeah, so this is the driving point of the whole thesis, that they have this land that's undervalued. So CTO's land is located at the intersection of I-95 and I-4 in Daytona Beach. It's a pretty attractive location for buyers, and we can talk about it a little later, but they're...
do some channel checking during spring break. You guys go down there and make sure you...
Yeah, so there's some talk that, or some of the research we did shows that property values are rising in Daytona Beach, and so we think this is an attractive location. So we broke it down, and we have a slide that shows this, but we broke down the land into 3 parcels. There's about 7,900 acres west of I-95. It's a little lower value. It's residential, industrial, and east of I-95. there are about 1,500 acres that's in the it's more commercial. It's
Oh, wow.
in the town, closer to the water. And then lastly, there's a parcel. This is parcel B on the map. It's 1,100 acres, and it's at the intersection of I-95 and I-4. As we're trying to figure out, because this is the driving point of the thesis, what is the value of the land? How do we value it? So we looked at, it's pretty imprecise how to do that, so we looked at all the available comps we could find. We dug through Daytona. This is website landandfarm.com. It has a bunch of current sales and previous sales that'll give us an idea of, okay, what is this land worth? And if the company were to sell off the land and reinvest, like Kevin talked about, what gains can they realize? We valued the land west of I-95 at about $10,000 per acre. So that's the cheapest parcel. And the parcel B, which is at the intersection of I-95 and I-4, it's about $25,000 an acre. And then the most expensive in the commercial area, parcel C, which we can see on the map, is about $75,000 an acre. I think the most important part of that, the analysis of the land, was that we used conservative estimates, and a lot of especially the parcel A was very heterogeneous, so there was a lot of different types of land, and away from the highway it's less valuable, so we tried to use kind of lower bound estimates. So
that's what you should always do.
Yeah.
I mean, it gives you, as you pointed out, and you had, I don't know if you picked up on this through just being near Seth Klarman at Baupost, which you guys write a little bit like that. You're using margin of safety. Yeah. That's the way that you do analysis. You take out the low end, so then you can't have somebody like me come in and say, hey, look, you're using peak valuations for this entire base. So I thought actually your valuation was quite conservative. If you look on the next steps, though, so now you have a big piece of land, you think it's worth more than what people think. You have to have a management team execute on monetizing that, and B, they can't do it in the year 2020. Because at some point you're just not going to get paid as a stockholder, unless you have some catalyst. So can you go through management?
Sure.
Like, you spent a lot of time in management. I actually find this to be one of the most interesting parts of the story.
Yeah, so the previous CEO, I believe his name Bill McMunn, he was let go from CTO in 2011, I believe, and the CEO.
That's when the stock stopped going down.
So
Okay.
the current CEO is John Albright. He was previously at Goldman Sachs' real estate group, Archon, and he, along with the CFO, both have experience in REITs, and they really bring a lot of expertise in how to execute the strategy that we think will deliver value to shareholders.
Yeah,
So-
Mark Patton, who's the CFO, worked at a number of REITs.
Yeah.
Okay. But these guys, as you said, they're not yet a REIT.
No, they're
But
still a C
It's
corporation.
part of, we'll get into it, but the catalyst, I'm sure.
Yeah.
So they're competent, they've been there, they've done that.
Exactly.
But he also was looking at this asset, Albright was, as an investor, was he not?
Right. So around the time that the previous CEO was let go, he petitioned the board and he asked to be CEO, and as a way, because he thought he could deliver value to shareholders by going about the type of strategy that we think could best unlock value. Another sign related to shareholders is there's an activist investor, Wintergreen Advisors. They own 26% of the company, and they were instrumental in letting go of Bill McMunn and bringing in Albright, and have kind of been on the side, the right side of things. So we see a lot of times you have value to be unlocked, but management can't do it because there's some intransigence. But here we find that, or we think that the management along with the shareholders are really well aligned to kind of drive forward.
Well, you have at least a third of the shareholders are either Albright, Patton, the management team, and I guess Wintergreen.
Yeah.
So you got a pretty good representation there. But when I looked at the rest of the shareholder list, it's still relatively thin. So that means when I look at a list like that, particularly we look for hedge fund screens. Like you'll typically find one or two smart hedge funds are in there early. I didn't see that either. I mean, there may be. I think I saw. I don't even know if they're a hedge fund, but in Greenwich there's a firm called Adillusion. They have like 3%, but that would be like the biggest piece. I think Carlson Capital had a 1% position.
Right. Yeah.
But this isn't like some kind of name with a bunch of hedge fund guys running around in it.
No.
It's basically the management team with Wintergreen.
Yeah.
No, there's not much sell side coverage or anything like that either.
No.
Okay. So the management, I mean, that's a great component of the story. Anytime you can find something where the financial incentives are lined up with obviously with the stock and the potential series of catalysts. Catalysts, that's what you spent a lot of time on. Kevin, you said, look, I think I found something that other people have not figured out, or at least your team did. I'm assuming there was a lot of work that was put into this.
Absolutely.
So can you go through those catalysts?
Absolutely. So I think this is kind of the part that makes us most excited about CTO. It's that, when we were looking through the investor deck in August, the management put out this slideshow that said we are thinking about potentially selling, this piece west of I-95 and this piece east of I-95, but no guarantees. But in the acreages and the descriptions, they seemed very specific. So we thought question mark came up, and we're like, can we figure out more information about these sales? Because if we can, that gives us an edge. So what we did was we Googled around, and ultimately Carlos and I found this website, which basically contains the property records for all properties for sale in Daytona Beach.
Nice.
And just scrolling through those.
You didn't have to pay for it. It was public.
No, it's public information.
Okay.
And so, there's like 80 or 100 records there. And so we just scrolled through. The first 20, nothing came up. Then the 21st or so, we saw something along the lines of Consolidated-Tomoka, and then it got cut off.
Really?
So we clicked on that. And then
that's sneaky.
Exactly. And so we found there's like 5 of these records in the entire set. And among those, you had things like, rezoning records, property records, traffic impact analyses, like everything. So one big catalyst we found was Minto Communities had petitioned the government of Daytona Beach to allow them to rezone a big chunk of the land, 1,600 acres west of I-95.
Wow.
To allow them to build like a master plan community according to their strategy. And so we matched up the blueprint on that to the map of CTO's land that the management provided, and we were almost sure that it's going to be there. Mm-hmm. And a month later, it was announced that Minto was planning to buy that piece of land.
Oh,
exactly.
Wow.
Yeah. And some other examples are we looked through Daytona Beach's daily newspaper, and there was like this announcement about potentially building a Sam's Club. And so we matched that up with Google Maps, just sort of like low cost primary research here, and figured out that was probably CTO's land as well. Mm-hmm. Some similar stuff. KB Homes. We looked through the records. So there's 2 homes on Tuscany Chase Drive, which is right in the vicinity of CTO's property. And so we're looking at two houses with identical attributes. They look exactly the same on Google Maps, but one of them is owned by CTO and one's owned by KB Homes. Very recent purchase. So we're figuring, they're probably, KB Homes is probably planning to build out this area as well.
Wow, that's like real research. I mean, you guys get, this is the kind of thing, I've been in the hedge fund business for a long time. People they genuinely think that a lot of research has been picked over, and the real research, you can't do as much of it. I think part of that is that you have people running too much money at this point. So for them to focus on a smaller cap name like this and dedicate a lot of time and effort like you did actually doesn't happen quite as much as it used to. Like when I got into the business, that's all we would look at is sub $500 million names that could double. Right. And that's a great job that you kind of dug in and found your own catalyst. I mean, how good is that? Yeah. If you didn't find the catalyst, what would you guys have done?
We actually, even besides those catalysts, we're fairly confident about management. And so a lot of the other research we've done is kind of figuring out, is this management team reliable? Because, so in HFAC and a lot of the personal investing we've done, you find a lot of companies.
Which HFAC?
HFAC is the Harvard Financial Analysts Club.
Cool. Yeah. I'm a Yale guy, I didn't know that.
Yeah. Like you'll find a lot of companies, even just like tiny companies that are like nets or like Ben Graham type companies that are trading at below net current asset value, and you're like, wow, this is so exciting. But then ultimately you realize a lot of these are just dead money because nothing's going to happen. The assets, no one's going to unlock them. So, I think a big part of it was kind of getting comfortable with management.
So you're like, these guys are predisposed to behave in this manner.
Exactly.
And now I'm just finding evidence to support that they're indeed who
doing what
said.
Right.
Because they have this strong history of working in REITs, so they know the business and they know what they need to do to unlock the value.
Yeah. It's like this great NFL commercial that it's like, they are who we thought they were. That's exactly what's going on here. So when you kind of look forward at a series of, do these guys, they haven't been like out in the open with a bunch of conference calls, they don't self-promote. How do you actually think through this becoming obvious to the investment community? Because people truly don't know this stock.
Yeah, absolutely. So as you mentioned, they're not promotional. In their slide decks, they always under-promise and over-deliver.
Right.
So a few things. So one is the land sales will naturally happen, and we think that's going to happen in the next year or two. So we just saw the Minto community sale announced.
And there was an uptick in the price on that
Yep.
day, about 5%.
That was
So when you could see that, when they monetize, boom, the stock goes up. Okay.
it's early November, and but on a higher level, kind of, you see this transformation from a very sort of hard to value asset, that's the land that could be like partially wet land or whatever in Florida, into a very easily valuable asset, and that's the income properties, right? Like all you have to do there is apply a cap rate to a net operating income. And so sort of that structural change will bring a lot of investor attention and more comfort as they get more comfortable with the value of what all the assets are worth as an aggregate.
Right.
And another step is kind of, right now one issue that CTO faces is there's kind of a dearth of institutional buyers, natural buyers. What I mean by that is they don't have a dividend, so income investors aren't interested. They're not a REIT, so REIT investors aren't interested.
Right.
But they have a lot of the attributes that would easily allow them to fulfill that need.
Well, you made a really interesting point. I don't know who wrote this point specifically, but in reading it, it's kind of odd to read it that way. But we're in this investing cycle where people are literally chasing yield. So you can see all these yield codes. You guys, I'm sure, have analyzed a lot of these different types of companies. People are chasing yield, and here you have a company that's actually been criticized for investing too much, as opposed to just punching out a big dividend and making a bunch of people happier.
Right.
But that really would, if you were to turn it into a REIT, it would put it on a whole new map of different types of investors. So that would be interesting. Have they discussed that at all?
They haven't explicitly,
No,
but
we think looking through their presentations online, we think that it's been alluded to.
They are REIT guys. That
yeah,
would be
exactly. So
That's one
there's
thing.
also, that's the big hint there. And also just because they have a large amount of deferred income taxes on their books, and based on our understanding of the IRS code, if they over time, if they convert to a REIT and hold the property or at least invested in like-kind property, those deferred income taxes are wiped after a certain period of time. So we think that's
a huge number.
Exactly. So
and here you guys have it at over almost 33 million bucks is the deferred tax. Wow.
So that's just free. If they go through with it, we think that's just free money sitting there.
Well, it is. I mean, because from an enterprise value perspective, as you guys know, you just subtract that from the enterprise value, and the equity becomes worth more. So that would be an explicit catalyst. When you look at the risks, away from, I think we've actually talked a lot about them. I mean, the timing is a risk. Management is a risk. But macro risks, when you think about where we are, if you look at this chart, and it's just a very simple kind of an overlay, but if you look at the peak of this stock going back, I think it was 2004 to 2006. It looks a lot like a company called St. Joe. These things were just massive plays on real estate. Here we are. We've been a very good real estate cycle. And at least our firm's research would suggest that there could be deflationary forces in the marketplace, not only in the commodity markets, but potentially at some point in the real estate market. Have you guys thought about that in terms of a prevailing wind or at least a threat to your property values?
Absolutely. So there's sort of two ways we think about this. So one is in the valuation, which I can discuss later, we have a case where we basically give a very high cap rate just to be very conservative.
Yeah, I think you guys used like 9, didn't you? Use a 9,
and then
cap
in
rate?
sort of our rate
high.
hike, we have a 15% cap rate on our real estate. And even in that case, we're only seeing like maybe 20% downside. So that gives us some protection. Seeing as similar property collections right now are at like 6 or 7% cap rates. So
if you were to weigh the risks and you say, okay, look, I don't, under any real estate environment, I don't care, because what they're doing is they're actually executing. They're selling, and even if they sell at 20 to 30% less, I get paid. Or do you truly hang your hat on the real estate value itself? What's more important?
I think the former is more important. And that also comes into play because you have to think of these guys as disciplined real estate investors. So in an environment where real estate properties go really low, that just creates more opportunities for them to buy.
Because these guys aren't looking to just dump the land
Right.
and get it off their books. They're trying to do it in a way that gets a fair price for the land and for the shareholders. So we don't think that it is a risk, of course, that real estate goes down, but we don't think that the management will not be able to handle that kind of risk.
And then there's the whole upside. I mean, the blue sky here is that they actually take that cash and turn it into something else.
Right,
Exactly.
absolutely.
I mean, they've had, I guess, is that a risk to you, or is that just the legacy? I mean, they got some crappy golf course on there. You have, I don't know if it's probably a nice golf course, but you guys don't really give it any value from an income generation perspective.
No.
Is that legacy risk or is that go forward risk?
Yeah, that I think has to do with what their business used to be, and they were founded over 100 years ago, and they were really
a long time.
Yeah, they're really a landowning business. So they have some subsurface oil rights and a couple other miscellaneous items on their balance sheet. And we think that that's just something that over time we may see them either unload or it becomes a smaller percentage of the.
Yeah, you guys really didn't. I mean, I was quite surprised. I mean, usually when you get analysts will kind of overrate different assets just as those assets are on the balance sheet, but you didn't give really any value to the golf course, to the oil piece, to that's not really core to your thesis.
No. Yeah.
Is there anything else you got grilled on from the Canadians or anybody else or otherwise in the debates? What was the best question you got?
I think one interesting risk to think about is, someone said, say you get paid over 20 years. So say I buy your thesis that like this company is 50% undervalued. If that happens over 20 years, like why is that an IRR that I like? And the answer is obviously no. So how do you think about that timing? And so one way we thought about it is because they're a bunch of near-term catalysts, that gives us some comfort that it's not going to be one of these like real estate plays that takes an infinite amount of time to play out. But the second thought is, say you have a 10% discount rate. You kind of make up for that in part if you say like, real estate appreciates long-term at 2 or 3% a year. Plus Daytona Beach real estate is very, very attractive. Daytona Beach is growing. You're constricted on one side by the coast. There's only one way to grow, which is west, and that's where all of CTO's land is.
The land is right by the highway, which
right.
If you look at the map, the commercial area is just hitting I-95 and I-4, so we think it's going to keep going.
Well, yeah, it's not entirely surprised that those would be the best questions. I mean, it's always about timing when you have a case that has to be monetized. I mean, this is what you have. You have a bunch of real estate. You need it to be monetized, and if it's not monetized, somebody's going to say that's not really interesting to me. It just looks like what it is, on the balance sheet. So that's an interesting one. Did you guys get pressed in any other way that may have annoyed you or you were like surprised or anything at all?
I think one question you got. Oh, that's a good question, yeah.
Which one?
You want to take that one?
Sure. So there was
I can't explain it too well. It's a tough question.
There's a question about
sometimes tough questions don't make sense, by the way.
One of the judges asked us about the cap rate, and so he's basically saying like, 6% cap rate. Does that really make sense for a CVS or Walgreens? Because like we can kind of use, CVS or Walgreens' long-term debt as a proxy for that.
Yep.
And that's a good call. And I think at a certain point, like 3 or 4% yield, that doesn't make sense. It just does. There's no rational world where that real estate gets 3%, 4% cap rate. But because we're using 9 or 10% cap rates, and that's pretty comfortable for us.
Did you put that cap rate in after you got tough questions, or did you have that high cap rate in, right from the get-go?
We had that going in.
You did?
Yeah.
So it's not your first rodeo, guys. Congratulations. That's why you won. Well, thanks for taking the time to explain it. I'm sure everyone on Seeking Alpha is going to be excited to see that you guys have been doing this for a certain period of time. Some people have been doing this a very long period of time, and you taught them a lot. So on behalf of them, I'm sure I'm saying thank you as well.
Thank you very much for having us.
A big Hedgeye congratulations again to the Harvard team from the Harvard Financial Analysts Club. Again, Carlos, David, Elaine, and Kevin did a great job on this idea. If you have any questions about the idea, you can ping me at Keith McCullough. You can also find us at Seeking Hedgeye, and you can find their team's work on Seeking Alpha.